You have probably heard the term IPO thrown around on the news, in finance apps, or maybe even at dinner parties, especially when a big name company decides to go public. But let me ask you this. Do you know what an IPO is and why companies go for it? Today, we're going to break it down in a simple, clear, and story rich way. So let's dive in. What exactly is an IPO? IPO stands for Initial Public Offering. It's the moment when a privately held company decides to go public, meaning for the first time ever, they sell their shares to regular people like you and me through a stock exchange. Think of it as a company throwing open the doors and saying, "We are ready to share ownership with the world." The Facebook story. Let's rewind May 18, 2012, the day Facebook went public. Until then, Facebook was a private company, backed by early investors and venture capitalists. But when it launched its IPO, it raised a staggering $16 billion in one day. Overnight, it became one of the biggest IPOs in history. That moment marked a shift not just for the company, but for every investor who believed in Facebook's future and wanted a piece of the action. Why do companies go public? Good question. There's one core reason: capital. By launching an IPO, a company can raise huge amounts of money to fund expansion into new markets, product development, debt repayment, or even big acquisitions. Going public is often the next big step in a company's growth story, but it's not an easy one. The IPO process. Behind the curtain. Before a company goes public, it has to go through a lot. Audits to make sure financials are clean. Valuations to decide what the company is worth. Regulatory filings, including registering with SEBI or the SEC. And usually, an investment bank steps in to manage the process, set the offer price, and create demand. So when you see an IPO on your trading app, remember there's a whole year or more of planning behind that single moment. What's in it for you, the retail investor? Here's why IPOs can be exciting for investors. First, early entry advantage. You might get shares before they hit the open market, sometimes at a discounted rate. Second, liquidity. Once listed, those shares can be sold at any time on the exchange. Third, growth potential. You're investing in a company that's just starting its public journey. If it grows, so does your investment. But a quick reality check: getting an IPO allotment isn't easy. The IPO lottery, a game of luck. When popular IPOs hit the market, demand often far exceeds supply. That's where the lottery system comes in. If you apply for an IPO, your name goes into a random draw, and if you're lucky, you get shares. It's a bit like standing in line for concert tickets, hoping your number gets called. So next time you're excited about a big IPO, apply early. But don't be surprised if you don't get shares. The demand can be massive. Final thoughts. IPOs are more than just a buzzword. They're turning points in a company's journey and a powerful opportunity for investors. But they come with their risks, processes, and hype.